Hi friends, good morning. Exams are coming nearer and I hope your preparations are really well. I know there will be days where you'll be feeling bit low. Sir, I'm not able to study. Sir, I feel I'm giving my efforts but nothing is going in my head. That all is routine. I'm telling you that all is routine. Please make sure you don't give up till the last examination day. Just make sure you keep going. Starters are many, finishers are few. Don't give up. Okay, now as exams come nearer, as a student, we tend to think about the amendments and updates. Sir, what are the amendments and updates which are there in the subject of FR, financial reporting? Now, if I just go to ICAI website, they've come out with a new material. I just go to student section. In that BOS knowledge portal, in that final course, and we have financial reporting, CA final paper 1 financial reporting study material. Now if you just check, they have a study material relevant for May 2021 examination onwards. So May 21 exam onwards, there's a new material which has came, and this is the new material. Actually they call it as November 2020 edition. If I just go over here below, they've clearly written it's a November 2020 edition. The edition is November 2020. So in simple words, ICAI has came up with a revised study material, and based on that, whatever updates are there, that we are going to discuss it today. Okay. So we have CA final, financial reporting, updates based on revised ICAI material. This is applicable for May 21 exam onwards. Now one thing, there are as such no amendments in FR. I repeat, as such no amendments in FR. Few updates ICAI has done in their material, we are just adding it to our material. So all the students who have attended my face-to-face batches or video lectures, whatever you have done over there remains as it is. I'm clarifying, whatever you have done in video lectures, face-to-face batches, that remains as it is. This is additional to be done. Yeah, this is just based on the new material which has been released by ICAI. So few additional questions, few additional concepts. Few additional questions, few additional concepts. So whatever you have done, that remains as it is. This is just additional. Okay, this sheet is already shared with you on my Telegram channel. If anybody has not downloaded it, this sheet will also be available in the link below. The description, this link is also given to you. So sir, what are the things which are covered over here? I've covered all chapters other than your pure Ind AS. Now see, Ind AS I have recorded in last 3-4 months only. It's almost updated. And I've covered all COVID related questions which ICAI has put up now. So Ind AS में as such there are no changes. FR में few updates were there other than the Ind AS part में. I'm just taking that currently. So what do we have covered over here is your chapter 5 unit number 2, that is your share based payment. Then we have business combination, consolidated financial statement, analysis of financial statement, integrated reporting, corporate social responsibility. Okay, so this is the portion which I take at Bangalore in my face-to-face batch. Based on that, these updates have been drafted. Again reminding, these are additional things. Whatever you have studied remains as it is. Okay, let's start. We start with chapter 5 unit 2, share-based payment, Ind AS 102. Now in your share-based payment, few additional questions they have added, I have put up over here. It's just for your better understanding and better preparation. Few questions are added. I'll be taking only the ones which I feel are difficult, or I'll be taking the theories which are added. I repeat, few questions which are difficult and the theories which are added, that will be taken. Other things which I feel are simple has to be covered by you only. Okay, the illustration 1, It's very simple. You need to do on your own self-study. Illustration 2 is on modification. Illustration 2 is on modification to Esop. Now, whenever there's a modification, the incremental fair value of option, the incremental fair value of option is to be amortized over the remaining vesting period. Now, sir, how do I find the incremental fair value of option? Incremental fair value of option is nothing but fair value of modified option. Okay, so we have some fair value of modified option and we compare the fair value of original option today. That is fair value of original option on the date of modification minus the fair value of modified option on the date of modification minus the fair value of original option on the date of modification today. So I had some option, uska value today. I revise the things. Now what is the modified option worth today? The incremental expense is to be booked over the remaining vesting period. Okay, so over here, if I just see in September 2002, fair value of option was 0.9. Directors repriced the option. They changed the exercise price. And now the fair value has increased to 1.05. Okay, so original option had a fair value today 0.9 and the modified option has a fair value 1.05. 0.15 increase. 0.15 increase will be amortized over the remaining vesting period. Original expense, what you are booking, will remain as it is. Additional expense will be booked over the remaining vesting period. We have done questions like this. This is simple. Okay, the solution you can do on your own. This is basically the original fair value and the incremental 0.15 is booked over the remaining vesting period. This is incremental. Okay, coming to the next question, illustration number 3. Okay, illustration number 3 is cash settled share based payment. Now whenever it's a cash settled share based payment, we treat it as a liability. You have to pay cash. So yeah, cash to be paid will depend on price of shares, correct? That's why it comes under share based payment. So as you are paying cash, it's treated as a liability, and liability we are required to remeasure it at the end of every year. Every year end it has to be remeasured. Okay, the total there were 40 employees. We granted 1,000 options to them and we expect 10% of employee will leave. Okay, 2 years is vesting period. So there are 1,000 options, 40 employees. We granted on 1st January 05. They will vest in December 6. Okay, we granted January 05. They will vest December 6. After 2 years. So 5 full, 6 full. And management estimates overall 10% employees will leave during the 2 years period. Okay, overall 10% will leave during 2 years period. Now pay attention. If it is equity settled, we use the fair value of option on grant date. But if it is cash settled, fair value of option on grant date is not relevant. We have to take first year end pay, first year end ka fair value, second year end, the second year end fair value, because it is remeasured every year. It's a liability. Okay, so expense which we need to book, it is 1,000 shares. Out of 40, 10% employees will leave to 36. Okay, the 36 employees. And first year end it's 12 rupee. And we have to book over 2 years. So half. Okay, if I just go over here, so it becomes 36 employees into 1,000 into 12 first year end into this is 1/2. Correct? So this is the expense to be booked. This much is liability in your books now. Now, Second year end, the liability will be remeasured, brought to its current value. Now liability should be based on 8 rupee. Now liability should be based on 8 rupee, and now it will be wasting at the end of second year. Full expense should have been booked. So 36 into 1000 into 8. The liability will be 288. Already it was 216. Expense for the year is 72. Liability is 288. Already we had booked 216. Expense for the year is differential 72. Okay. Now wasting period over. Exercise period will start. Now pay attention. Now pay attention please. We have booked expense based on 8 rupee. Now they are telling on 31st December 17 or December 7, when intrinsic value was 10. Okay, intrinsic value is nothing but excess of market price of share today over the exercise price. So whatever was specified price, I say above 125, whatever amount will be there, I'll pay you in cash. So today the excess is 10. Okay, so we need to pay 10 rupees. So December 7, your value was 10. 6 employees exercise the option. Okay, 6 employees exercise the option. We have to pay 10 rupee to them. Expense booked was 8. Okay, I have to pay 10. Expense booked was 8. So 2 rupee additional I have to book. Okay, so I will be booking 6 employees into 1000 into 2 rupee. Okay, 6 employees into 1000 into 2 is 12,000. And now for the remaining 30 employees, they take in next year. Okay, remaining 30 employees they take in next year, year end. For that 30 employee, liability remeasured, brought to current value. Okay, so pay attention. We had booked expense for 36 employees at 8 rupee. Now 6 employees are paid 10. Remaining 30 will be paid next year. But I have to bring that to the closing rate liability. Okay, so 6 employees I'm paying them 10 rupee. 8 was already booked. 2 comes expense. And for remaining 30 employees, I bring it to closing rate 13. Okay, so now, how did you get this 1,62,000? I just have it over here in a simple way. 6 employees in 2,000. You have to pay them 10. Already booked is 8. So this is coming as 12. And for the remaining 30 employees, you bring it to the closing rate 13. Already booked is 8. So it is 5 rupee into 30,000, that is 1,50,000. Total is 162. Total amount 1,62,000. We have booked expense of 8 rupee. For 6 employees we are paying 10. Additional 2 is to be booked. And for the remaining 30 employees, they are exercising it next year. But have to bring the liability to closing rate. We have booked at 8. Closing is 13. That's why we are bringing it to 13. This is the closing rate. This is closing rate. If you want, just copy it. I just come in a minute. Okay, and liability balance. Sir, how do you get this liability balance? 30 employees into 1000 into 13 rupees. The liability balance is 30 employees into 1000 into 13 rupees, the closing balance. $30 employees into 1000 into 13 rupees, the closing balance. Okay, now for this 30 employees, expense what we have booked is as per 13. 8 tha, we booked additional 5, now it is as per 13. Okay, and when they exercise, the intrinsic value is 12. When they exercise, the intrinsic value is 12. We have recorded expense as per 13. 1 rupee will be reversed. So 30 employees into 1000 into 1, 30,000 is reversal. Okay, so how do I get this? This is 30 employees into 1000 into, we have booked 13, it should be 12. 1 rupee is reversal. 30 employees into 1000, we have booked 13, it should be 12. When they are exercising, 1 rupee is reversal. Okay, done. These questions we have already done in class. I thought it was bit calculation to be shown, that's why I covered it. For 36 employees, we had booked expense as per 8. Now next year 6 are exercising, we are paying 10, so 2 rupee expense came. For remaining 30 employees, we bring it to closing rate, which is 13. Okay, next year that remaining 30 are exercising at 12. So we have booked expense 13, actual expense came 12, 1 rupee is reversal. Next, these are the journal entries, fine. Okay, next question is good. You can tick third one important, fourth one important. Third important, fourth important. Now, in this question, we have again cash settled, SAR. Only difference is they've given one more thing. What if the P modifies the award to require only 3 years of service? See, earlier award means option. The options needed 4 years of service. Earlier option needed 4 years of service. What if they modify it, make it 3 years? Sir, when? They make it at the end of second year of service. Okay, so from the end of second year we understood total wasting period will not be 3 years, it will be 2 years. This is a separate question. Okay, what if this was done? Would your answer be different? Okay, so first of all, we will solve the question as if the wasting period is 4 years. We'll solve the question as if wasting period is 4 years. And as it is SAR, fair values are to be remeasured every year. That'll take 210, 220, 215, 218. Okay, so 210, 220, 215, 218. That way we need to take. Okay, go down to the solution working notes. Go down to solution working notes. This sheet was already shared on Telegram channel and I had requested you to take a printout of it so that when this lecture is taken you have a printout with you. Okay, without modification. See, expense is based on 210, 220, 215, 218. Yeah, 1/4, 2/4, 3/4, 4/4. So this is without modification. Now if at the end of second year we understood total vesting period will be 3 years. Now, when did we understood? End of second year. The first year will remain as it is. The first year based on 210 1/4 as it is. But our second year end, we understood total vesting period will be 3 years. Now 2 are already gone. So 2/3 should be booked. 2/3 should have been booked. Second year में modification vesting period is actually changed. Now it will not be 4 years. Total vesting period will be 3 years. इसका effect is given prospectively. Vesting period changed. Effect will be given prospectively. Okay, so first year tak we are not knowing. The first year tak we thought total vesting period is 4 years. First year gone, 1/4 to be booked. Now second year end we realize total vesting period is 3 years. 2 are already over. So 2/3 should have been booked. And last year mein full should have been booked. Okay, this is the only change. I hope you're clear. Then going to the next. Now, share-based payment transaction with cash alternative. Okay, you are required to do this updates once you are done with your syllabus fully. So once you are done with all the lectures normally, then this is to be done. Please don't see this in between. You're done with the syllabus, then only these updates are to be seen. Now, cash alternative. So what we were doing when there was a cash alternative? Employees can take cash also, employees can take shares also. What do we do? So we are finding out liability component, equity component. Okay. If all employees go for cash, if all employees go for cash, how much I have to pay them? That's a liability component. If all employees go for shares, what is excess payment compared to them going for cash? Okay, if they go for shares, what is the excess payment here compared to what they go for cash? The employee going for shares, employee going for cash. If they go for shares, what will be the extra payment over there? That's equity component. Okay, so if you remember, on grant date, we find out the fair value of option assuming everybody goes for shares and assuming everybody goes for cash. Now, whatever amount is coming in cash, that's liability component. If they go for shares wala option, what is the extra coming? That's equity component. Liability component is accounted as per SAR. Equity component is accounted as per Esops. Yes, we have written all the theories. Now this is fine when counterparty has a choice of settlement. Okay, who has a choice of settlement? Counterparty. Okay, there's no change over here. This is already there in our books, the theory what we have written. So when counterparty, opposite party, employees, they have a choice of settlement, then we bifurcate into two parts, liability component, equity component. If they go for cash, what I have to pay? That's liability component. Excess payable under shares wale settlement, that's equity component. For liability component, accounting is like SAR. Equity component, accounting is like ESOPs. So this is when counterparty has a choice of settlement. Employee will decide what they want. Now this is already there in our book. What is new is the second part. This is not there in our book. This we have not covered. Entity has a choice of settlement. Who has the choice of settlement? Entity. Okay. If employees have a choice of settlement, We assume everybody goes for shares and we also assume everybody goes for cash. Now shares में generally the number of shares we give them is more. Cash में they get cash for lesser number of shares. Under share settlement, bit value will come extra. That extra was equity component and balance was your liability component. That was when counterparty had a choice of settlement. If entity has, I have to decide. Company has to decide whether to give you cash, whether to give you shares. If employee decides they want cash, they want shares, that's counterparty. If company decides, I will decide whether I want to give you shares, whether I want to give you cash. Now in that case, if past experience all suggest that company every time gives shares, company every time gives shares, then treat it as Esop only. But our past practices, the current scenario, everything suggests company will go for cash. Past practices, current scenario suggests company will go for cash. Treat it as SAR. तो यहाँ पे not liability component, equity component. No. So when you have a choice of settlement, the whole award. Now see the word. When entity has a choice of settlement, whole award will be treated. Your whole award is important. Either it is fully cash settled or it's fully equity settled. Either treat it as SAR or treat it as ESOP. That's it. You can't have part SAR, part ESOP. When counterparty had an option, we are dividing in two parts, equity component, liability component. Liability component accounted as per SAR, equity component accounted as per ESOP. तो part हो गया. But when entity has a choice, whole award will be either this way or this way, not part. Okay. So now they are telling, when entity has a present obligation to settle in cash, you treat it as liability. So when entity has a present obligation to settle in cash, now sir, how do I know? Entity has option. So you see the past practice. So one, there is no commercial substance to issue equity, or there is a past practice or a stated policy to settle in cash only. So there is no commercial substance to give shares. Shares देंगे, they will have more ownership. Yeah, if they will come, I don't want people coming in my company extra. So past practice, stated policy, terms and conditions, वो सब देखते हुए, past practice, policies of company, terms and condition, this all if I look into, I feel company will give cash only, account as per SAR only. But if I feel no, company will go for shares, then account as per ESOP. But if there is no obligation to pay cash, then you treat it as equity settled. Okay, so either wholly, no part, no equity component, liability component, no, wholly treat it like ESOP, or either wholly treat it like SAR. Based on past practice, the policies which you follow, terms and conditions of option. Now sir, I thought I'll go for cash. I did accounting as per cash. Later I give shares. I thought I'll give cash. Later, Corona aa gaya, cash is not there. And now I give shares. What to do? Okay, so if you had earlier thought you will be giving cash only, you had SAR, provision for SAR in your books. The provision for SAR in your books is there. ठीक है. That will get converted into equity share capital. The provision for SAR is there. That will get converted into equity share capital. But sir, earlier I thought I'll give equity. Earlier I thought I'll give equity, now I'm giving cash. Do you have SBPR in your book? SBPR goes away, you give cash. If you give extra, the extra cash what you give will go in P&L. So SBPR is there, na? SBPR debit to cash. If you are giving extra, extra will go to P&L. Okay, simple words. When counterparty has a choice, we bifurcate the option in two parts: equity component, liability component, and part accounted as per Esop, part accounted as per SAR. But when entity has a choice, you decide whether to give cash, whether to give shares. If entity has a choice, full award, whole word is very important. Whole is treated either as cash settled or whole is treated either as equity settled. So पूरे का पूरा, no part. Full will be treated as cash settled or equity settled. This is when entity has a choice. Sir, what to do in exams if questions are silent? What to do in exam if questions are silent? If questions are silent, treat it as counterparty has a choice of settlement. Who has a choice of settlement? Counterparty has a choice of settlement. What we have done in class, same things will remain. Clear? Okay, this is fine. Nothing is given. We always assume counterparty has a choice of settlement. Okay, like this question. See, यहाँ पे if employee chooses cash alternative, share alternative, employee chooses, so alternate counterparty. So what I need to do? So same, I need to find out if all going for equity, if all going for cash. So whatever comes under cash, that's liability component. Whatever comes under equity, over and above that, that is your equity component. I'll bifurcate in two parts. So this is fair value if they go for equity, if they go for cash. Now this is treated as liability. Ye extra 15,200. So 1 lakh and this is 115. Extra 15,200 will be treated as Esop. So that's equity component. So we are bifurcating plan in two parts: equity component, liability component. Hope you're clear. Counterparty has an option to choose. Bifurcate plan in two parts. Entity has the option to decide either wholly as per Esop or wholly as per SAR. Don't bifurcate. Okay, so this is fine. Now the next one, group share based payment plan. Group share based payment plan. Okay, now group will mean your parent and the subsidiary. That's it. Not your associates, not your joint venture. It's parent and subsidiary. That's it. So group covers your parent and subsidiary. Okay, now pay attention. Many times employees of subsidiary के employees, they work at subsidiary, but they'll be getting the shares of parent. Okay, the parent is giving shares to the employees of subsidiary. Okay, the services are received by subsidiary, but shares are given by parent. And sometimes parent's employees are given subsidiary share. So it is possible subsidiary's employees are given parent share or parent's employees are given subsidiary share. Now, how to account for this? We already done in class. Still, I'll tell you again. Whichever company receives the services, whichever company receives the goods or services, they record the expense. Okay, so now simple words. Parent gives shares to the employees. Parent gives ESOPs to the employees of subsidiary. Okay, so employees are working where? Parent is giving shares to the employees of subsidiary. Okay, the employees are working where? It's a subsidiary. The expense will come in subsidiary. Expense will come in subsidiary. But who issues shares? Parent. The 2 SBPR, yeah, 2 equity share capital, that will come in parent. Okay, the subsidiary may expense debit, parent may SBPR credit. What will parent debit? Parent will treat it as investment in subsidiary, and subsidiary will credit. Subsidiary will credit capital contribution by parent. Okay, so parent gives ESOPs to the employees of subsidiary. Entry. How will be the entry? The subsidiary ki books mein employee benefit expense debit. Employee benefit expense debit. 2. They are not giving shares. Parent will give na. So 2 capital contribution by parent. And what will be entry in books of parent? Investment in subsidiary debit. Investment in subsidiary debit. 2. Share based payment reserve, या equity share capital, whatever. Okay, if parent is giving something to subsidiary, it's treated as investment by parent. But if subsidiary is giving shares to employees of parent, if subsidiary is giving something to parent, it's treated as dividend distributed to parent. The parent दे रहा है, that's investment in subsidiary. Subsidiary दे रहा है, that's dividend to parent. This we have already done. Now important is this 2 points. This is the addition. See, many things which were already there also I have put over here, because to explain this 2 line I need to give you the context base. So this was already there. This is the new addition. So don't think, sir, ye 68 pages are all new. No. Out of 68 pages, 20-25 pages are kind of which were already there. I've given you to make you understand the changes. The amendments or updates are hardly 40-45 pages. And उसमें भी questions है mostly. Theories are 10 pages. 10 pages भी नहीं, 5 pages theory change है. Okay, now pay attention. If I ask you a question, employees of subsidiary will be getting shares of parent. Employees of subsidiary will be getting shares of parent. Now, question is it a equity settled or cash settled for subsidiary as well as parent? I repeat the question. Okay, let me write over here. Employees of subsidiary will get shares of parent. Employees of subsidiary will get shares of parent. So now this transaction is equity settled या cash settled? Is this transaction equity settled या cash settled for subsidiary as well as parent? Is it equity settled या cash settled? Now someone will say, sir, employees are getting shares. Employees are getting shares. So sir, it's pakka equity settled. Employees are getting shares. Sir, it's pakka equity settled. यहाँ पे cash settled कहाँ आया? Okay. Now, if I change the question and write employees of subsidiary will get cash from parent which is based on share price of parent. Okay, if I ask you the first one, employees will get shares of parent from parent. Okay, shares of parent, but कहाँ से? Parent के पास से. So whether this is equity settled or cash settled, you will say, sir, payment is by shares, it's equity settled. Sir, यहाँ पे payment is cash, it is cash settled. So you will see payment by shares, equity settled, payment by cash, cash settled, but that is not correct. Pay attention. So whether this transaction is equity settled or cash settled, तो उसके लिए if you go and check definition of equity settled, the definition of equity settled says either you give your own equity share, or if you don't give anything also, either you're giving your own equity share. If I give my own equity instruments, or I give nothing, then it is equity settled. But if I give cash based on price of my share or anybody's share, if I am giving cash, it's cash settled. Okay, I repeat, if I give shares own equity instrument, if I give own equity instruments or I give nothing, it's equity settled for me. Like both the cases, first case, subsidiary will not pay anything, parent will give shares to employees of subsidiary. The first case, subsidiary is not going to pay anything. Second case also, subsidiary is not going to pay anything, parent will give cash to the employees of subsidiary. So both the case, subsidiary is not paying anything. If you give your shares or you don't pay anything, it's equity settled. Okay, so for subsidiary, both case is equity settled. They don't pay anything. No need to write, already given to you. Either you give your own shares or you don't pay anything, that's equity settled. Both cases, subsidiary is not giving anything. They are receiving services, so they will book an expense. It will be treated as equity settled for subsidiary. Now parent, first wale case, parent is giving their own share. Parent giving, you are paying by own share, it's equity settled. Second wale case, you are giving cash. So for parent, it is cash settled. So subsidiary will account it as equity settled. Fair value will not be remeasured. But यहाँ पे second case में parent will account it as per cash settled. Fair value will be remeasured every year. I hope you are getting clear. Okay, so now just go. First wala case, subsidiary doesn't pay anything. Second wala case also, subsidiary doesn't pay anything. If you don't pay anything, it's equity settled for you. Either you give your own shares or you don't pay anything, that's equity settled. First case, parent is giving own share, it's equity settled. Second case, parent is giving cash, it's cash settled for them. So second wala case, subsidiary will account as equity settled, fair value not remeasured. Parent will account as cash settled, fair value remeasured. I hope you're clear. And as parent is paying to parent will book as investment, subsidiary will book as capital contribution, that will remain same. But amounts, subsidiary will not remeasure, parent will remeasure. Okay, now check the theory. The entity receiving goods and services, like हमारे केस में subsidiary, shall measure the goods or services as equity settled. Okay, the entity receiving goods and services should measure at equity settled when when you grant your own equity instrument or you don't pay anything. You have no obligation to settle. Okay, the entity receiving goods or services shall measure as equity settled when. So you measure it as equity settled when either you give your own equity or you don't have any obligation to settle. First case, parent will give shares. Subsidiary doesn't have obligation to settle. Second case, parent will give cash. Subsidiary doesn't have obligation to settle. So both the cases, subsidiary doesn't have obligation, it's equity settled for them. Now, for the entity settling the transaction, they should recognize as equity settled only if they are giving own shares. Those parent, if they give own share, it's equity settled. If they are giving cash, it's cash settled. If parent is giving own shares, the entity settling, यहाँ पे वर्ड था ये रिसीविंग गुड्स एंड सर्विसेज, यहाँ पे वर्ड है सेटलिंग, शेयर बेस्ड पेमेंट. तो एम्प्लॉयज आर वर्किंग एट सब्सिडियरी, हु इज गेटिंग गुड्स और सर्विसेज? सर एम्प्लॉय, सब्सिडियरी. तो सब्सिडियरी इज गेटिंग गुड्स और सर्विसेज. इफ parent is to pay, the subsidiary does not have any obligation. For subsidiary, it's equity settled. For parent who is settling, if they are going to give shares, equity settled. If they are going to give cash, cash settled for parent. So it is possible subsidiary accounts as per equity settled, parent accounts as per cash settled. I hope you are clear. I hope you are clear. Okay, this 2 sentences important. Okay, the examples which I took, it's given here. Parent will give its own shares. Parent will give its own shares to the shareholders, or sorry, to the employees of subsidiary. Parent giving shares. Subsidiary, no obligation, it's equity settled. Parent giving shares, it's equity settled. Subsidiary gives its own shares to the parent. Okay, the parent, no obligation. Subsidiary giving shares to parent, no. The parent may no obligation, equity settled. Subsidiary giving shares, equity settled. Okay, this was the one which I told you. Parent settles by paying cash for share-based payment plan issued by subsidiary. Parent will pay cash. Parent will pay cash. So if you just see subsidiary receives goods or services for which it does not have to make payment. As it does not have to make payment, it's equity settled. Parent has to pay cash, it will be cash settled. Parent will have to pay cash. The subsidiary receives goods and services, they don't have obligation to pay, it's equity settled. Now the settling party, parent, they are not giving own shares, they are giving cash, it's cash settled. Sir, difference क्या आएगा? Parent treats as cash settled, they will remeasure the option or basically the liability every year. Subsidiary treats it as equity settled, they will not remeasure it. The amounts in both the books can be different. Amounts in both the books can be different. I hope you're clear. Okay, next. Question 6, mark it as important. Question 6, mark it as important. The only difference over here, subsidiary will reimburse to parent 75% amount. Okay, 75% they will reimburse. So subsidiary S agrees to reimburse P over the term 75% of the expense which is recognized. The 75% I'll pay. Okay, so see, if parent gives shares to employees of subsidiary, expense comes in subsidiary, SBPR comes in parent. And वहाँ पे they will have investment in subsidiary, यहाँ पे capital contributed by parent. Now capital contribution don't take full, 75% we are paying. Okay, so whatever expense we book, the expense is 15,000, 555. So whatever expense we book, 75% will pay, remaining is capital contribution by parent. The 75% we are paying, remaining is capital contribution by parent. Same way for parent. Okay, SBPR every year 5,000, 75% we receive, 25% is only investment in subsidiary. The investment in subsidiary is 25%, 75% we are receiving, that is bank. Okay. So this is the only change in this question. 75% subsidiary is reimbursing over the term. You book expense, 75% you will pay to bank. Remaining is contribution by parent. The 75% you pay to parent. Remaining is the capital contribution. Okay, just a minute. This is 75. This is 25. I hope you're clear. Done. Chapter number 5, share-based payment over. Chapter 5, share-based payment over. Going to the next one, business combination. Again, once you are done with our normal classes, then this updates is to be seen. Don't see the updates now. Whatever was done in classes, that all remain. These are few additional things. Lots of water keeps you fresh. Every 15-20 minutes, half an hour, you should have a bit of water. Now, chapter number 13, business combination. In your chapter 13, business combination, they have added one concentration test. Okay, so whether it's a business or not, uske liye they've added one concentration test, and they've done bit of modification in the definition. They've done bit modification in definition. Okay, what is a business? It's a set of integrated activities and asset. Sir, it was same. Integrated activities and asset that is capable of being conducted and managed. That's capable of being conducted and managed to provide what? To provide goods or services to customer. Okay, so I have activities, assets, I manage them, I'm able to produce goods or services, give it to my customer. Generate investment income or any other income from ordinary activities. Okay, this is what is there. The last point में bit modification is done. To generate, for providing goods or services to customer, for generating investment income or any other income from ordinary activity. And normally for business, you need input, process, output. To be a business, input, process, because see the word is, it's an integrated set of activities and asset. It has to be activities, process, capable of being conducted and managed. So normally for business, we need input, process, output. Now, output is not mandatory. Sir, we had that question also. So if you just see over here, integrated set of activities and asset must include at minimum you need input, processes which have a ability to create output. So minimum you need input, substantive process. Okay, the word they've added is word substantive. This word is added, substantive process. Process which are very important, which cannot be easily replicated. Processes which are very important, which cannot be easily replicated. If I don't take your process, I can get it very easily outside. That way it should not be there. Minimum, you need input, substantive process that together significantly contribute to the ability to create output. So output may not be there now, it may come up in future. To be a business, we need integrated set of activities and assets. An integrated set of activities and assets should include input and substantive process. A word substantive process is added. So this is what is added. किसको बोलेंगे substantive process? Substantive process. What is called substantive process? If output is not there, that process is very critical to create the output. If output is not there, the process is very critical to create the output. तब बोलेंगे substantive. Okay, then when do I say it's substantive? If set of activities and asset do not have output, they do not have a output at acquisition date. When do I say process will be substantive? Process shall be considered substantive only if. तो process को कब बोलूँगा substantive? It is critical to create output. If it is critical to the ability to develop or convert input into output, if that process is very critical, तो उसको substantive process बोलूँगा. And your input is something which cannot be replicated. The input is something which cannot be replicated. Input includes both organized workforce and other inputs that organized workforce will use. Okay, so process is critical to the ability of converting input into output, and input is not generalized. Input is kind of organized workforce. Both condition fulfilled, then I say yeah, the process is substantive process. It's just a theoretical thing. Exam angle not much relevant. It's given. I have to teach you. Okay, so imagine normally business have input, process, output. It is possible output may not be currently, then also it can be business. So even if output is not there, it's fine. Minimum you need input, substantive process. When do I say it's a substantive process? If output are currently not there. This process is critical to the ability to develop or convert input into output. The process is critical and inputs are not generalized. Simple words, input are not generalized. They are organized workforce with skill, level, knowledge, experience. So they are not kind of generalized input. Okay. If output was not there. Sir, what if output is already there? If output is already there, then the process should be critical for continuing the output. Output nahi hai, the process should be critical for developing output. If process is already there, output is already there, then process should be critical for continuing the output. Okay, so if set of activity has output है already, then acquired process shall be considered substantive if it is critical for ability to continue producing output. वहाँ पे था to develop or convert the input into output. Output है ही नहीं, तो process should be critical for converting input into output. If output is already there, process should be critical to continue the output. Or, see, here the word is or. Above it was and. Here it was and, here it is or. Or it significantly contributes to the ability to continue producing output and is considered unique and scarce. So this process is unique, scarce. This process cannot be replaced without significant cost. Okay, so either it is critical to the ability to continue producing output and the input acquired are organized workforce, etc. And the input acquired are organized workforce thing, or it is contributing to continue, it's contributing to ability to continue output, and this process is kind of scarce, cannot be replaced without significant cost. If this process cannot be replaced without significant cost, you're not going to change it, you're going to use it, it's substantive. Okay, pay attention. So they are telling for a business, okay, for a business combination you need a business. For a business combination you need a business. Business is not there, it's not business combination, it's asset acquisition. If it's not business, it's not business combination, it's asset acquisition. So for a business combination we need business. Business is nothing but a set of integrated activities and assets capable of being conducted and managed to generate returns. Now, set of integrated activities and asset includes minimum input, substantive process, whichever ability to create output. Now, when do I say process is substantive? Okay, when do I say process substantive? If currently output is not there, process is substantive, it is critical to develop or convert input into output, and the inputs are not generalized. Or if output is already there, the process is substantive. Output is already there, process is substantive if it is critical to continue the output and the inputs are not generalized. Or the process significantly contributes to the ability to continue output and the process is scarce or process cannot be replaced without significant cost. Anything met, it is a substantive process. Hope you're clear? Yeah. Agar output nahi hai, it is critical to convert input into output and inputs are not generalized. If output already hai, it is critical to continue the output and inputs are not generalized, or you are not able to replace this process without significant cost. So we were substantive. Okay, so one word they added was substantive process, and this is something which they have added to decide whether it's a business acquisition, business combination, or it's a asset acquisition. They came out with a test called concentration test. This is optional. They came out with a test called concentration test. Okay, I tell you a very simple thing. You acquired my business. You acquired my business. Net asset acquired by you is 1,000 rupee. Okay, the fair value of asset minus liability, the fair value of net assets. Fair value of net asset is 1,000. अब वो 1,000 में से 900 is building. Imagine, you acquired all my assets and liabilities. The fair value of net asset is 1,000, but out of 1,000, 900 is building. तो यार, actual में you acquired building. बाकी all is negligible things. है ना? If you acquire my cash, यार cash को नहीं गिन सकते cash acquired. I took cash, I gave cash. ये क्या है? तो see the concentration test. This is optional. Whether it's a business or not, we can evaluate from the normal definition. But before going for normal definition, integrated set of activities, assets, वो सब है कि नहीं? Simple. First do a concentration test. The concentration, the name only says, it's an optional test. If concentration test is met, it's not a business. तो पता चल गया, out of total value, 90-95% is this one asset only. If 90-95% is this one asset only, I can say it's not a business acquisition, it's an asset acquisition. If concentration test is met, it's not a business, no further assessment required. If concentration test is not met, further assessment is required. Concentration test not met means it can be a business. No, it's not a business, it can be a business. So before analyzing whether it's an integrated set of activities and asset capable of being managed, वो सब analysis करने से पहले you can go for concentration test. It's optional. It's optional. Okay, now how do I do concentration test? Just go down. Okay, I just read the next point only. The concentration test is met if substantially all of fair value of gross asset. If substantially all. Now what is substantially all is not defined. 80%, 90%, it's not defined. If substantially all of fair value of gross asset acquired is concentrated in a single identifiable asset or a group of similar identifiable asset. So whatever you acquired उसका fair value. So I acquired your assets, liability, तो fair value of your net asset, assets minus liability. Fair value of your net asset is 1,000. उसमें से 900 is building. The fair value of gross assets acquired. Gross asset includes gross assets and liabilities. So whatever I acquired, gross asset is nothing but net asset. I just write here. Gross asset is nothing but net assets acquired. Whatever net assets you acquired, but our calculation is done differently. So whatever net assets you acquired, I acquired assets, liabilities, net comes 1,000. उसमें से 900 is building only. उसमें से 900 is building. So can I say it's concentrated at one place? So concentration test is met if substantially all of fair value of gross assets acquired is concentrated in a single identifiable asset or a group of similar identifiable asset. ठीक है? Let's go down now. Next page. You have the steps. मिला नीचे last में. Measure fair value of gross asset acquired. Identify the single big asset. And now see proportion. क्या वो substantially all होता है? तो gross asset acquired is say 1000. 900 is single identifiable asset. 1000 में से 900 90%. So then that's concentration test is met. If concentration test is met, it is not a business, it's asset acquisition. Okay, now how to find out fair value of gross asset? See, whatever they were given, take it that way. Whatever they have given, take it that way. Okay, just a minute. This is just to remove this. Gross asset is gross only, not net asset. Gross asset is gross only, not net asset. Just remove that line what we wrote. Gross asset acquired. That's correct. I told you it's similar to net asset. No, it's not similar to net asset. Gross asset acquired. Gross assets acquired. Out of all your asset, gross asset, if it's concentrated at one place, you acquire total gross asset. Leave liabilities. Asset 1000, 900 is building, so that basically 90%. Now calculation is done differently. Now just see how calculation is done. The first find gross asset, single big asset, and whether it's substantially all of fair value or not, compare. Now how to find gross asset? How to find gross asset? A plus B minus C. Okay, fair value of gross asset shall be determined A plus B minus C. What is this? Okay, A. Fair value of consideration transferred, including fair value of NCI, fair value of previous interest held. Okay, in simple words, fair value of entire entity which we are taking over. Fair value of entire entity. So, fair value of consideration transferred. Imagine I acquire 70%. I gave you this much. So, this is 70% ka value. Plus you have to include NCI, 30% का value. So 70% का value, 30% का value, this is total value of entity acquired. This is nothing but total value of entity acquired. Point A is nothing but total fair value okay, I just write wait, is kind of total fair value of entity acquired. How much you paid? This is 70% का. Okay, 30% का fair value क्या है? This is the total gross asset. Now ये gross asset, this is the total value of entity. उसमें assets आ गए, liabilities आ गए, everything. This is for 70% plus I take fair value of 30%. This is your 100% business. I want only asset. I want only asset. ये तो पूरा business asset liability सब आ गया. Add back the liabilities. तो value of business में because of liability value has gone down. Because of liability when I'm doing a value of business the value has gone down. I want only assets. Because of liability, value has gone down, add back liabilities. So we add the liabilities, and in the assets we should not consider cash, deferred tax asset, goodwill arising from DTL. So वो सब are not to be recorded, so that is to be deducted. Cash निकाल दो, deferred tax asset, same way deferred tax liability also removed, and goodwill arising from DTL. You record a DTL. You record a DTL. The fair value of net asset goes down. आपने DTL record किया, fair value of net asset will go down, goodwill will increase. I'm paying you something. I compare the net assets. If DTL I record, fair value goes down. The fair value of net assets goes down. I pay you fixed amount. तो difference goodwill में आ जाता है. Okay. So how to find out fair value of gross asset? I acquired currently 70%. So this is what I pay for 70. 30% का value is this. The fair value of 30%. NCI. Total value of business. This total is nothing but asset, liability, everything. So this value, because of liability, has already gone down. I want only asset. Add back the liability. So when you did valuation of business, because of liability, business ka value has already gone down. If you want only gross asset, add back liability. And now I don't want to consider cash taken over, deferred tax asset. They are not, deferred tax asset is not real, no? So remove that. Okay, they've given these three things. Take it like this. DTA, DTL are not considered. Okay, the fair value of liability assumed. So इसमें भी DTL will not be there because DTL is actually not a liability kind of thing. Okay, so let's see the example. Let's see the example. A holds 20% in B. You already hold 20% in B. You acquire further 50% by paying 300 crores. Okay, you hold 20% in B. You acquire further 50. Okay, 20 hai, 50 acquired. The total 70 is ours and 30 will be NCI. ठीक है. Fair value of asset acquired. Building, cash, financial liability, DTL. Now, fair value of entity B is 400 crore. Now someone asked, sir, if fair value of entity B is 400 crore, we acquired 50%. I should have paid 200. You already hold 20. You acquire further 50. Now fair value of entity B is 400. We acquire 50%. I should have paid 200. Sir, why did you pay 300? Yaar, to get a controlling interest, I might have paid more. So fair value of entity B 400 crores. If I acquire 50%, I should have paid 200. Students have asked me doubt. I should have paid 200. Sir, why are you paying 300? Why are you paying 300? To get controlling interest, I might have paid more. ठीक है. And fair value of NCI. Fair value of NCI 400 crore is valuation. उसका 30%. And our previous interest, uska fair value 400 crore ka 20%. Sir, we paid 300 crore for 50%. What you pay, that don't see. Fair value. You should have paid 2, but you paid 3. You should have paid 200, you are paying 300 just to get controlling stake. ठीक है. You are required to evaluate whether it's an asset acquisition or a business combination. Okay, so asset acquisition, business combination. First, I'm going for concentration test. Fair value of gross asset acquired. Okay, fair value of gross asset acquired. Okay, consideration transferred 300. Including, now add, fair value of non-controlling interest is 120. Fair value of previous interest 80. Okay, so 300 I paid for 50%. Earlier 300 I paid for 50%. Earlier 20 ka fair value is 80. NCI 30% का fair value is 120. So this is your A point. This is what I paid 300. This is NCI. This is previous interest का fair value. तो total 500 crores. 50% के लिए I paid 300. 30 with NCI, उसका fair value is 120. Earlier 20 with me, उसका fair value 80. The total value of company is like 500 crores. So don't take 400. Formula दिया है, use formula. Don't directly take 400. They have given, you do it that way only. Okay, so I paid 300, वो 50%. 300 I paid, that's for 50%. Now NCI has 30%, उसका fair value today is 120. I have 20%, उसका fair value today is 80. Total 500. Total 500. Now add back liability. Okay, don't add DTL. Only the financial liability 800. Add back liability and deduct cash DTA. DTA is not there. Cash 200. So this is fair value of consideration transferred, fair value of liability assumed. This is cash. Fair value of gross asset acquired is 1100. 500 plus 800 liability minus cash and DTA. Cash 200 वो निकाल दिया 200. Fair value of gross asset is 1000. इसके अंदर 1100. उसके अंदर building is, out of 1100 building is 1000. 91% is just one asset. This is gross asset. उसमें से 91% is just one asset. So they say concentration test is met. It's not a business. So in our view, we consider 91% as substantial to conclude transaction as asset acquisition. So it's not business acquisition, it's just asset acquisition. Okay, the first. How do I find fair value of gross asset? Okay, you acquired something now. Whatever you paid for that. NCI का fair value. Previous interest का fair value. I acquired now, I paid something. NCI का fair value. Previous interest का fair value. This is value of now 100%. 100% entity. Asset भी आ गया, liability भी आ गया. 100% entity. I want gross asset. Add back liability. When I did value of business, उसमें asset, liability, everything. If I don't want liability, add back liability का amount. So we add back liability other than DTL. And then you deduct asset में से cash, DTA, because that's no point. Cash ले लिया doesn't mean business लिया. So remove cash, DTA, that all you remove, and now A plus B minus C, you're getting fair value of gross asset is 1100. Out of 1100, building is 1000. 91% is just one asset. It's not business combination, it's asset acquisition. I hope you're clear. So if concentration test is met, it's not a business. If concentration test is not met, do further assessment. Okay, next page you have a chart given. Chart is the same thing what we did in definition. Chart is the same thing what we did in definition. We'll be having 2 lectures because we won't be able to finish it in one class. So 2 sessions will be required. Okay, next, acquisition through issue of equity instrument. Okay, I take over your shares, I give mine. I take over your shares, I give mine. So that is by giving equity shares. Now these things are already there in your book. It's already given in your material which we have done. So many times I take over your company के shares, I give mine. कई बार after I give you my shares, you hold majority in my company. I take your shares, I give you mine. But now after I give mine, you hold majority in my company. उसको बोलते थे reverse acquisition. So who is the acquirer? So who has a majority voting right? Who has the largest minority? Who controls the governing body? So who is the acquirer? उसके लिए this thing is given. And they've added 1 or 2 questions. That's okay, you can study on your own. So 1 or 2 questions are there, that's fine, that can be studied on your own. Okay, next we had business combination achieved without transfer of consideration. Business combination achieved. You got a control, but you're not paying anything. You got a control, but you're not paying anything now. Sir, ऐसे कैसे? Okay, you hold 40%. You hold 40. Others were holding 60. Company comes with buyback. Others are giving back the shares. You are not giving. You hold 40. Others hold 60. Company comes with buyback. Others are giving back the shares. You are not giving. Now your holding percentage wise increases. Okay, I just tell you it was 100. You hold 40. Others were holding 60. Company comes out with buyback of 25. So now it's 75. You don't give anything. Others have given 25, so now their holding becomes 35. So earlier yours was 40%, now your holding is greater than 50%. So this is one. There were 3 examples given. There were 3 examples given to you. And third one was just by contract or agreement alone. One is a profit-making company, other is a loss-making company. One is a profit-making, other is a loss-making. Loss-making company tells profit-making company to handle their operations. You handle our operation, profit will share. The money is theirs. I don't invest single rupee. I just handle your operation, profits are shared. So I get a control without transfer of consideration. Now in this case, when I get a control without paying anything, यहाँ पे I already had earlier some money paid. So I will remeasure earlier interest. Earlier interest remeasured, all that thing is there. But when I don't have a single share of yours, I don't have single share of yours. You are badly managed. I manage it very well. You tell me to control your company, manage it. I'll do it. I'll do it. Now I get a control, but I have not paid anything. I don't have a single share. 100% will be NCI. So should I consolidate? Yes. 100% is NCI. We have written theory. Material already there. This is a question on it. So I don't hold a single share. 100% will be NCI. The fair value of Sita is 100. Fair value of Beta is 80. So unke net assets are 70. NCI I have to show at fair value. Full everything is NCI. So NCI will be 80. NCI will be 80. Assets of 70 comes. Extra 10 will be goodwill. Yeah. So I don't hold a single share. Still, if I have a control, I have to consolidate. Sir, I don't hold single share. Full NCI. Full is NCI. We have done theory. This is just one question added by ICAI. Next, illustration number 3. Okay, illustration 3 is very good. Now, whenever there is a business combination, assets and liabilities come in our book at acquisition date fair values. Assets and liabilities come in our book, acquisition date fair values pay. Okay, so we record. Imagine you become my subsidiary. You become my subsidiary while consolidating First time, acquisition date pay, your assets and liabilities are added. Acquisition date fair value. So CFS में your values which I take, and in standalone whatever values are there different, I have taken acquisition date fair values. Then your books, asset ka value has gone up. Tax purpose, they will not be taxed now, they will be taxed when that asset is really sold. So when I record at acquisition date fair value, if asset goes up, I don't have to pay tax now, I create DTL, I have to pay in future. Asset goes down, DTA. The acquisition date fair value, I record. Asset ka value going up, asset has gone up, tax I have not paid today, I have to pay in future, DTL. Value goes down, DTA. Liability goes up, DTA. Liability goes down, DTL. I have to compare what I record in book with the tax base. Ind AS 12, what is the value as per taxation? Don't see book values, value as per taxation. This will be useless. Okay, so as per taxation, these are the values of assets and liabilities. Tax base. And acquisition date fair value is this. Okay, so acquisition date fair value is 1070, tax base is 920. So books में asset increased. So I'll record as per fair values, I'll record 1070, asset has gone up, I should create DTL. So tax purpose, net asset this, books may will record this, asset has gone up, tax I am not paying today, it will be paid in future, DTL. Now sir, the rate, which rate DTL should be created? And this is important. Entity H, the tax rate is 30%, an entity as subsidiary 40%. Now this asset belongs to subsidiary. When subsidiary sells it, subsidiary will pay tax. This asset belongs to subsidiary. I am parent, I consolidate, that's it. But asset belongs to subsidiary. When subsidiary will sell it, subsidiary will pay tax. And subsidiary will pay tax at 30 or 40. This asset belongs to subsidiary. When subsidiary will sell, they have to pay tax. They will pay at 30 or 40? 40. So DTL create at 40. I will create at 40. Later I have to pay at 40. I hope you're clear. Okay, so this asset belongs to subsidiary. The difference is 150. ये 150 के ऊपर 40%. 150 के ऊपर 40%. Why 40%? I just write over here, these assets belong to subsidiary, and so when they are sold, subsidiary has to pay tax on it at 40%. So we create DTL also at 40%. These asset belongs to subsidiary. When they are sold, subsidiary will pay tax on it at 40%. So we create DTL also at 40%. These are just few questions and concepts added by ICAI. Whatever we have done in class or in video lectures, they are all as it is. So you can recommend your friends. There are no changes as such. It's just additional 2 lectures. That's it. Many of us have habit now, we delay our lectures till the end. We think I will take the lectures at end only so that I get latest. Yeah, this all subjects, FR, costing, SFM, this all subjects don't change much. Unless the standard changes, this will not change. A few questions ICAI may add, remove, that's fine. You can't delay your preparations till end. For CA final, last 5 months has to be self-study time. You should finish your coaching before 5 months of examination. Okay, let's move ahead. Next, CCBC, Common Control Business Combination. Now, if it's a Common Control Business Combination, it's accounted by pooling of interest method. If it is Common Control Business Combination, it's accounted by pooling of interest method. We don't record at acquisition date fair values, we record everything at book values. We don't record at acquisition date fair value, we record at book value, and previous year's figures are also restated as if we were together since beginning. Because CCBC, earlier also same control, now also under same control, it doesn't make a difference. So previous year's figures are restated to make sure we are there since beginning. Okay, now actually not we are there since beginning, we are there together since common control was there. Pay attention. Previous year's figures are restated to ensure that we were together only. Pehle bhi together the, but since the date common control was there. तो उसका question, this is important. Fourth one. Fourth question is important. How will financial statement of previous period be restated under common control scenario? Common control extends beyond the start of comparative period. वो previous year से भी पहले we had CC. Now if we come together, we need to restate the previous figure as if we are together since the date common control was there. Common control was there since beginning only. So previous year beginning से ही figures are restated. Previous year का figures changes comes in previous year. Earlier than previous year वो beginning of previous year restate हो जाता है. But if the common control started in last year. Okay, let's see the question. A point again. Beyond the start of comparative period. Okay, XYZ acquired PQR on 1st October 9. Year end is March. Both XYZ and PQR has been controlled by shareholders since incorporation. Okay, so this is 9-10. So 9-10 current year, previous year 8-9 also combine it. 8-9 beginning से ही assume we are together. Beginning से ही we are together. 8-9 beginning. So actually we are together since incorporation only. ऐसा मानना है. But this is 9-10. Previous year is 8-9. 8-9 का beginning. वहाँ पे figures we change it. But if you see second question, if you just see second question, ABC, DEF are controlled by shareholder A. A made investment in ABC in 2000. He made investment in DEF in 2008. The common control started from 1st October 8. Okay, 1st October 8 से common control started. 9 में there's a CCBC. 9 में there's CCBC. Previous year's figures will be restated. But common control started from 1st October 8. So previous year from 1st October 8 we are together. We are together since the day there was common control. The previous year's figures are restated in a manner, I just write over here. Previous year's figures are restated in a manner as if the entities are together since the day common control started. Since the day common control started. जब से common control start हुआ तब से we are together. Okay. We are coming now, but ऐसा मानना है कि since the day common control started, we are together. First वाले में common control is since inception. तो since inception we are together. That way restate previous year figure. And second, common control started from 1st October 8. Previous year's figures are restated as if we are together from 1st October 8. So for A point, previous year's figures are restated as if we are together since inception. For second one, the previous year's figures are restated as if we are together from 1st October 8. Okay, that's the answer which will be given. See, यहाँ पे as if the acquisition has occurred 2008. As if the business combination is occurred from the beginning of the financial statement. The beginning of previous year we give the effect. यहाँ पे as if it's from 1st October 8. I hope you're clear. I hope you are clear. Okay, entity A and B are in construction service. A is owned by group of individual, none of them control. And B is owned by Mr. Ram. Okay, the A, none of them control. B owned by Ram. Later on, A is also controlled by Ram, and then A and B come together. Later, A becomes controlled by Ram, and then A and B come together, but common control was transitory. It should not be transitory. So if you see, A is not controlled by anyone, B by Ram. Now later, A also comes under control of Ram, and then A and B combine. A ka control was for transitory, temporary. It's not CCBC. ठीक है, that's fine. You can read it on your own. 6th question is also fine. 5 and 6 you can read on your own. Business combination is done. Chapter 13 over. Chapter 14 I'll take it in second part. Let's do the other chapters. Okay, so this lecture I'm dividing in 2 parts. Other than CFS and CFS. So we are doing other than CFS. I'll come to CFS later. Okay, go down. Chapter number 15. Page number 47. Chapter 15, page 47. The first one, items to be presented in OCI section. There is no change. I've just given it over here for better understanding in a simpler words. You've done it in class in detail. This is just a better way in which I have presented. Items which will come in OCI section. Your statement of P&L. Under your Ind AS, Your statement of P&L has two parts, normal P&L and OCI section. The items coming in OCI, it's written. That's fine. You can refer on your own. Okay, coming to question number 1. Okay, due to COVID, there are some intangible assets which are impaired. Okay, due to COVID, there's a significant impairment in intangible asset. Huge loss will come. Similarly, there's a huge loss due to recognition of inventory at NRV. Cost or NRV, whichever is lower. The one, impairment of intangibles. Second, inventory values have gone down. Can you treat this as extraordinary and present separately in P&L? Now, as per your Schedule 3 format or as per your Ind AS 1, there's nothing kind of extraordinary under your Division 2. Nothing kind of extraordinary. If something is huge, non-routine, you can show it as exceptional item. There's nothing extraordinary, it's only exceptional. So can you show it as exceptional? Yes, this item can be treated as exceptional items if they meet the test of materiality incidents. So they are material, non-recurring, then it can be treated. But there's nothing extraordinary. No concept of extraordinary under Ind AS. Okay, question 2, important, whether this will come in P&L section, OCI section. P&L section, OCI section, where it will come. Remeasurement of defined benefit plan is OCI. Current service cost is P&L. Revaluation surplus is OCI. So remeasurement of defined benefit plan OCI. Current service cost. So employees worked for this year. This year's provision for gratuity is P&L. Revaluation comes in OCI. Foreign currency gain loss. This is translation of monetary asset. And this is foreign operation. Okay. Gain loss on account of translation of foreign operation. Foreign subsidiary, you convert their figures. That comes in OCI. FCTR, foreign currency translation reserve. But monetary asset is P&L. Asset ka value, debtor, we bring it to closing rate. That goes to P&L. The monetary asset, foreign operation. Okay, gain loss on investment in equity. So there is investment in equity designated as FVT OCI. Gain loss, investment in equity designated as FVT OCI. Fair value change will go in OCI. P&L tax comes in P&L. OCI items tax will come in OCI. OCI items tax comes in OCI. But if question is silent, we take this as P&L related. Share-based payment, employee benefit expense comes in P&L. Share-based payment, employee benefit cost comes in P&L. So these are the items coming in P&L. These are the items coming in OCI. They would have just bifurcated it. Done. Okay. Question number 3 is for your self-study. We have a similar question in classwork. Same question in classwork. Answer is given as per Division 2. Yeah, answer is given as per Division 2 of Schedule 3. We have already done it. You can just do it on your own. And next is important. Fourth question, important. Fourth question, important. Deepak started a new company, Soft Bharti Private Limited. Okay, Bharti is very soft. Soft Bharti Private Limited with Iktara Limited. So he started a new company, Soft Bharti, with Iktara, wherein 55% investment is done by Iktara, rest by Deepak. So in your Soft Bharti Private Limited, we have Iktara Limited. Iktara Limited is holding 55% and Deepak is holding 45%. Okay, simple words. Soft Bharti is subsidiary of Iktara. Voting powers are as per the capital. So Iktara holds 55%. Soft Bharti Private Limited is subsidiary of Iktara. Therefore, Soft Bharti Private Limited is subsidiary of Iktara Limited. ठीक है. Consultant was hired. He charged 30,000 for incorporation, and that is to be charged to P&L after incorporation. Okay, the once company is incorporated, 30,000 will go in P&L. And Iktara ke financials are as per Ind AS. Okay, Iktara's financials as per Ind AS. So uski subsidiary Soft Bharti should also be as per Ind AS. Okay, the Soft Bharti should also be as per Ind AS. Therefore, subsidiary Soft Bharti Private Limited's financial statement should also be as per Ind AS. Parent is following Ind AS, subsidiary has to follow Ind AS. Okay, we have a P&L given. Revenue from operations, other income, total revenue, purchase of stock in trade. There's increase in stock. Stock goes up, profit goes up. The expense may they have deducted. Stock goes up, profit should go up, expense kam kar diya. Employee benefit expense, depreciation, other expense, we have profit before tax, current tax, deferred tax, total tax, profit for the year. OCI section is missing. If you are following Ind AS, P&L part is divided into normal P&L, OCI section. OCI section is missing. Balance sheet. Ind AS applied. It should start with assets. It starts with liability. Okay, the format of balance sheet, it should start with assets. In your assets as well as liability, your financial asset, financial liability. So this format is wrong. ठीक है? Values are fine. Let's see ahead. Additional information of Soft Bharti Private Limited, DTL. In your question, there's a DTL 6000. Is due to temporary difference. Depreciation as per income tax, depreciation as per accounting profit. ठीक है? तो DTL 6000. Okay, in your property plant equipment there is only one property. Books में 1 lakh, tax में 80,000. Value as per books is more. Books में value more, there will be DTL. तो 20,000 का 30%, this is a 6,000 DTL. 20,000 का 30%, this is a 6,000 DTL. ये रहा, ये ना same. This is for this only. This is for this only. Depreciation in income tax is more, profit as per income tax is less. So depreciation ज़्यादा मिला, value of asset as per income tax is less. Depreciation more, asset का value less. So books में there is more, you have to pay more tax in future. DTL 6,000. Okay, pre-incorporation expense are deducted. वो 30,000. they are deducted straight line over 5 years under income tax. Okay, so income tax में allowed is 6,000 out of 36 allowed. तो book में asset is 0, income tax में 24. Book में asset 0, income tax out of 36 is expense. Out of 36 is expense. 24 is the value of asset. So book में asset less, we have to create DTA on it. This पे DTA will come. Okay, the 24,000 into 30%. 7200 will be DTA. So this is for DTA. Asset in books nil, asset in tax is 24,000. So how do you get 24? 30 minus 6. Therefore there will be DTA. Okay, current tax 30% of PBT. 355 is without doing any adjustment relating to income tax, and after doing allowances, disallowances, the current tax, the correct current tax is 125,700. We have to take this. Correct current tax is 125,700. Okay, and this will appear under your current tax liability. There's a separate heading, current tax liability, in your division 2. So under your current liability, current tax liability, and PNL में 125,700 current tax. Deferred tax we need to find. So one is, this is DTL 6,000, this DTA 7200. Let's see others. After the reporting period, after the year end, directors have recommended dividend. After year end, if you recommend dividend proposed, no entry. No entry. Entry for dividend is done only when it's declared. But it has been deducted from reserves and surplus. It has been deducted from reserves and surplus. Add back 15 in reserve surplus. Remove it from current liability. It has been grouped under other current liabilities. Remove 15 over there. So add back in reserves, remove from liability. There are government dues 15,000 which are grouped under other current liability. Statutory government dues. Statutory government dues are 15,000. Okay, statutory government dues will come under other financial liability. It's obligation to pay cash, fixed amount. Other financial liability. Under your current liability, financial liability, under that other financial liability. Capital advances 50,000 are grouped under other non-current asset. Okay, capital advances, yeah, they are not financial asset. I've given advance, I'll be getting PP, capital advance. I'll be getting asset. It is not a financial asset. The other non-current asset, it will be fine. Other current asset. Other current asset include 51,000 interest receivable from trade receivables. Okay, from trade receivables, debtors के पास से interest fixed amount to be received. It will come under other financial liability, other financial asset. This is other financial liability. This is other financial asset. This is remove from reserve and surplus and liability. You remove it, it should not be there. Current investment 30,000 in shares of company, which is for the purpose of trading. Okay, as it is for the purpose of trading, it should be FVTPNL. You have invested in shares of company, it should be FVTPNL. fair value 50. Fair value is 50. Book में it's 30. Make it 50. Make it 50. Current investment 30. उसका fair value is 50 and it's FVT P&L. Extra 20. Take it in P&L. So rupees 20,000 income in P&L. DTL will also come. Asset went up. Asset went up. So DTL will come 6,000. The asset instead of 30, make it 50. 20 comes in P&L, income. And now 20 asset increased. Tax may we have not yet paid tax. We have to pay in future. DTL. Okay, actuarial gain on employee benefit 1,000 omitted. This will come under OCI part. Actuarial gain will come under OCI part. And uske upar ka tax. Uske upar ka tax also in OCI. So there is a income. There is an income which is not charged to tax now. It will be charged to tax in future. There is an income not charged to tax now. It will be charged to tax in future. DTL. Also DTL. TK, financial statements are not yet approved. You are required to tell what are the changes required. Revised financial statement. So they have to prepare as per Ind AS. Subsidiary. Other income mein this 20 is added. Investments 30 now measured at 50. Investment 30 now measured at 50. So this is fine. You can just do on your own. OCI section has been added. Check. ये OCI. उसमें this actuarial gain वाला 1,000 gain. उसका tax 300. So net is 700. It's a gain. Net 700 gain. 300 is not current tax. Deferred tax है. Now let's just go to deferred tax ka note. Just let us go to deferred tax note. Other things you can do on your own. Okay, so in your PPE there is 6,000 DTL. That's fine. In your pre-incorporation expense 7200 DTA. Current investment 20,000 ka 30%. 6,000 DTL 4800. And what 300 DTL. This is 4800 and plus 300 DTL was for actuarial gain. Total 5100. Check यहाँ पे DTL. This is for actuarial gain. So in your balance sheet DTL will be 5100. P&L में 4800 300 OCI. P&L is 4800 300 goes in OCI. Balance sheet में 5100 together. In your balance sheet 5100. Okay, just one thing. Government dues, they are not basically arising due to some contractual obligation. It's due to law. Government dues are not contractual obligation. Financial liabilities are liability to pay cash equivalent due to contractual obligation. It's a contractual obligation to pay cash. Government dues are not contractual obligation. It will come under other current liability, not financial. Government dues will be other current liabilities, as it is not contractual obligation. Yeah, The definition is contractual obligation to pay cash or cash equivalent. This is not contractual, it's due to statute. So it's due to statute, not contractual obligation. Okay, done. This question is important. Please make sure you go through it thoroughly. I've discussed all the points. Just go through the solution once thoroughly. Next, we have chapter number 16, no change. And the last, corporate social responsibility, CSR. There are few changes over here. Few. Corporate social responsibility. Role of board, A to E point are same. F and G are changed. A to E are same, F and G are changed. Now F point, imagine they say you have to spend 2% on CSR. You have to spend 2% of your profit on CSR. What if you spend more? What if you spend more? Can I set it off again next year? If I pay more, can I set it off against next year? When we did in class, I told you no, but now there's a change telling you can set off in next year. If extra I have paid now, extra I have basically used now, I have to spend 2%. If I spend more, next time I can adjust it if I want. If I don't want, then up to me. So if company spends an amount in excess of requirement, company spends amount in excess of requirement, it may, not compulsory, may set off excess amount for such number of succeeding financial year in a manner as may be specified. So if I do more expenditure now, I have to spend on CSR 2%. If I pay more, can I adjust against next year? You may, up to you. Now sir, if I am not able to spend, I have to spend 2%. If I am not able to spend, should I make a liability? Should I create a provision for unspent amount? I have to spend 2%. If I don't spend, should I create a liability? Now, earlier I told you no liability to be created. No liability to be created, but you will have penalties, etc. Now, if at all you're not spent, government tells you, if at all you're not spent, you're required to transfer it to a separate account. If it's an ongoing project, you can transfer it within 6 months from the end of year. If it's not, if it's an ongoing project, you have to transfer within 30 days. 30 days from the end of financial year. If it's not an ongoing project, you have to transfer within 6 months. Okay, so any amount remaining unspent for an ongoing project, you have to transfer within 30 days to a special account opened by company in a bank account to be called as unspent corporate social responsibility account. And then you have to spend it. Such amount shall be spent within 3 years from the date of transfer. Okay, the first, if I spent more, can I set off the excess next year May? Yes. If I spent less, I have not spent. So if it's an ongoing project, within 30 days from year end, I have to transfer to a separate bank account. I should create provision for that, for the transfer to be done. And if it's not an ongoing project, I have to transfer within 6 months. I have to transfer within 6 months from the end of financial year, and I have to make a provision for the transfer to be made. Default kiya to penalties are there. So this is 135(5) and 6. If a company defaults in complying 135(5) and 6, okay, this F point is 5, G point is 6. So penalty, twice the amount required to be transferred. Twice the amount required to be transferred by the company to the fund or this account, or 1 crore, whichever is less. Or 1 crore, whichever is less. Okay, sir, 135, 5 and 6, I'm coming to it. It's given below, don't worry. So if you default, see, if it's not an ongoing project, you have to transfer to a separate fund. Fund hai wahan pe. Not an ongoing project, you transfer to separate fund within 6 months from end of year. If it's an ongoing project, you transfer to a separate bank account. Not an ongoing project, separate fund. Ongoing project, separate bank account within 30 days from end of financial year. Okay, I just write over here, not ongoing project. We have separate fund and transfer within 6 months. From end of financial year. Ongoing project. It is separate bank account. Transfer within 30 days from end of financial year. This is 135.5, this is 135.6. 135.5, 135.6. Not an ongoing project, separate fund, transfer within 6 months from end of financial year. Ongoing project, separate bank account, transfer within 30 days from end of financial year. If I spend more, can I set off excess next year? Yes. If I spend less, I have to transfer it to separate fund or separate bank account, and provision for transfer has to be done. You have to transfer, so uska liability has to be shown. This will come up. Okay, next. This is fine. This is already done. Permissible activities is same, just this is added. A central armed force and paramilitary forces. This is just added one line. I told you na, ये पूरा same ही है. ये one line के लिए I have given the full. Okay, whether provision to be created for unspent amount other than ongoing project, 135.5. Other than ongoing project, you have to transfer such unspent amount to a fund within 6 months from the end of financial year, other than ongoing project, and provision for liability for amount to the extent to be transferred needs to be created. So should I create provision? Yes. When we did in class, I told you no, this is the amendment. 135.5, 135.6 was not there earlier. 135.5, 135.6 was not there earlier. Other than ongoing project, transfer within 6 months to a fund, and provision for transfer has to be done. Okay, ongoing project. Ongoing project. Achha, both are actually 135.5. Person to any other activity other than section 135.6. Okay, 135.6 is this. Other than ongoing project is 135.6. Just change above. Above when we wrote, just change it. and this is 135.5. Just change above. First page of the chapter we wrote, वहाँ पे change कर लो. Okay, if it is ongoing project, amount remaining unspent shall be transferred within 30 days to a special account with a bank and shall be spent within a period of 3 years. So ongoing project, transfer it to a separate bank account. 30 days में you can spend it within next 3 years. You don't spend it, then transfer to fund. Failing which you transfer to the fund. हाँ, you don't have an ongoing project. कुछ नहीं किया आपने. Give it money to the fund. Fund will use it. Give money to fund. It's similar to that IPF वाला Investor Education Protection Fund. यहाँ पे Corporate Social Responsibility Fund handled by government. And same way, provision for liability to the extent amount is to be transferred needs to be recognized. Provision for transfer needs to be recognized. I hope you are clear. So ongoing project, year end, 30 days के अंदर put it in separate bank account, use it in 3 years. You don't have an ongoing project, do one thing, give the money to government, they will use it. Give it to the fund, they will use it. You have to transfer within 6 months from end of year to the fund. Government will then use it. Okay, this was the change. Whether excess amount can be carried forward, answer is yes. So this is the change. As per the third proviso, excess amount would be allowed to be carried forward to next year. Would be allowed to be carried forward to next year. Now the word was may. याद है? तो if the company decides not to carry forward, the company decides not to carry forward, then they will treat it as expense. If you think you will carry forward, you show an asset. Asset will be recognized for an amount which is spent in excess of 2%. If you want to carry forward, show it as an asset. If you don't want to carry forward, full now will be expense, no asset. If you want to carry forward, extra spent is asset. If you don't want to carry forward, full amount spent is expense. Done. This is okay. Illustration 1, you can read it. It's fine. Expenditure made in kind is fine. Other consideration is also fine. Accounting entries. Accounting entries. If you spend in cash, CSR expenditure to cash. If you give goods, CSR expense to COGS or to purchases. If you spend in cash, CSR expense to cash. Kind में goods, CSR expense to cost of goods sold, or if you're a trader, so to purchases. Okay, amount not spent. Not spent, you have to deposit. Actually 135.5 other than ongoing. 135.6. This was correct actually. यहाँ पे mistake is there. Just go up. Ongoing is 135.6. Ongoing is 135.6. Other than ongoing is 135.5. Other than ongoing is 135.5. ऊपर बराबर था. Page 1 was fine. Page 1 was fine. Other than ongoing is 135.5. We have to transfer to fund. Ongoing we have to transfer to separate bank account. Okay, so going back to journal entries. Okay, when you're not spent fully, the CSR expense debit, this is what you have spent. This is the amount spent, and not spent you have to deposit in fund. And ongoing project, so that has to be deposited in separate bank account, but uska bhi provision has to be done. So that will appear as liability. Okay, excess if you want to carry forward. Excess you want to carry forward, you show it as an asset. Excess you want to carry forward, you show it as an asset. So expense debit, excess is asset, total to bank. Excess which you want to carry forward, you show it as an asset. If you don't want to carry forward, take it in P&L. If you don't want to carry forward full expense, then don't show asset. If you don't want to carry forward, no asset. Okay, this is done. Illustration 2 you can read on your own. It's important, but just read it on your own. Presentation disclosure. Okay, the only thing in presentation disclosure is they've added about ongoing project, not an ongoing project, how much money you kept aside, how much you spent out of it, all that things. The 135.5 is other than ongoing project. This is ongoing project. So I think both are given under 135.5 only. 5.6 is common for both. Take it like that. 135.5 and 6 is common for both. Opening balance, amount deposited in fund, required to be spent during year, actually spent, closing balance. See, fund may you will deposit within 6 months. Till that time you're not yet deposited. The opening is this. This is the opening. You have to deposit to the fund within 6 months. Okay, plus your opening tha. This is what I have to spend this year. This is what I have spent. And this I'll deposit to fund. If not deposited, it appears as closing. Okay, unspent amount, amount required to be spent, amount spent, and closing. So opening, amount required to be spent, amount spent, closing. Same way over here for ongoing project, opening balance with company with separate bank account. आपके पास कितना? Separate bank account. This is required to be spent. Spent from company, from separate bank account. Closing with company, separate bank account. The opening with you and in separate bank account, because separate bank account you have to transfer within 30 days of year end. You might not have transferred till then. And once you transfer, you have to use within 3 years. So opening with you with the separate bank. This year how much I have to spend? Now how much spend from mine, from separate bank account, closing with me and with separate bank account. So this are just additional disclosures which have been added. So disclosures may only this point is new. This point is newly added. Okay, that's it. We are done with all chapters other than consolidated financial statement. That we do it in second lecture. I'll call it as part B. Part A, part B. Just remember one thing. You might not have reached yet, but you're closer than you were yesterday. You might not have reached yet, but you're closer than you were yesterday. Keep putting your efforts, keep moving. You will definitely reach closer, 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 and definitely you will succeed. But if you stop trying, things will never work. I'm telling you only one thing. Don't stop in between. Your effort should continue till the last exam is over. Okay, see you all. Again, we'll meet with part 2. Bye bye. Take care.